Peter Eliades with you. This is Stock Market Cycles special YouTube update for Sunday, September 14th. I've been doing these YouTube updates for several years now, and I have to tell you that I have never been more excited about doing an update before. I'm going to show you something very special today, and I think you'll probably be one of the very few people in this world to have this discovery before you. How you use it is up to you. But before I go into that, and believe me, it's going to be fascinating, I want to emphasize this. We offer a free trial to our video commentary, which we do every market day. On the weekends, we do a weekend update that goes on sometime between Friday and Monday. And that gives you price projections and all the technical work that I do. And believe me, I don't think anyone works harder at market analysis than I do. Now, some of you will say, oh, ladies, yeah, come on. You're always calling for a top. You're the biggest bear around. Well, I'm not going to defend myself, but I can guarantee you I have not been the biggest bear around for my 50-plus year career. I was the biggest bull around back in the let's say the 82 bottom, the 74 bottom, which I called virtually to the week, December 9th of 13th, 1974. And we're going to be talking about that in a bit on Los Angeles television, KWHY. But yes, I have been bearish for several years now and looking for a very major top in the market, and there are a lot of reasons for that. One thing I want to show you, however, for those of you that are saying, oh, look at the market's gone straight up, Eliades, and you've been a bear all the time. Let me show you a chart that belies that. Okay, you can see here, this is a chart of the value line geometric index. Now, why is the value line geometric index of interest? Well, because there are 1,700 stocks in it. It takes a representative group of stocks from all areas of the market. Technology, New York Stock Exchange, over-the-counter composite, puts them all together, but they are unweighted. From day to day, they take every one of those 1,700 stocks, get the percentage change for each individual stock, put them all together for the day, and that comprises the index. The calculation's a little more complicated than that, but that's the basis behind it. So I wanted to show you this chart, the chart of the value line geometric index. And I believe it's up to date through this past Friday. But for those of you that are saying, oh, you've been bearish, Eliades, and we've just been going straight up. Well, the time I really started getting bearish was, let's say, 21-22. That's 2021-22. Right in this area right here, you can see the scale below of the numbers. This is 2020. Here's the big low in 2020. Here's 2022. The all-time high in the value line geometric index occurred in October, November of 2021. Basically 4 years ago. This is the top right here. Came down to a low in late 2022 and has rallied back again. This is, I believe, late 2024, early 2025. Then this big decline into April of this year, and now we've come back here. But take a look at this chart. First of all, we're down over the last 4 years. And second of all, look at the statistic down here in the bottom left. Since this 2000 high in the value line geometric composite index to the current day, the value line has advanced 23.7%, and that comes up to 0.8% per year. Now, I know if you look at the other indexes and averages, you can say, no, that doesn't make any sense at all. Look at the S&P. It's gone up and up and up for years on end. Remember, you're looking most of the time at capitalization weighted indexes that are showing you stocks like the NVIDIAs of the world and the Microsofts of the world and the Amazons of the world. 4 or 5 of those stocks make up almost 20% of the complete value of the New York Stock Exchange. And those are the ones that you see in the indexes. Okay, I don't want to waste any more time on this. I just wanted to show you what the overall market, what the average person's rounded portfolio, let's say, has been doing. And it's been doing nothing for 4 or 5 years now. Okay? Let's go back to this. If you go to stockmarketcycles.com/register, because this is such a crucial time period in the market, and you don't spend a penny, there are no obligations whatsoever. You're going to get, instead of this 7-day free trial, you're going to get a 14-day free trial, completely free, no obligation whatsoever, of what I think is the best market analysis in the world. Combination of my price projections and the cycle work that I do and the technical work that I do. Those of you who have been around, or those subscribers that have been around for the last 40 or 50 years, yes, I started a service in 1975. That is 50 years. Hey, this is my 50th anniversary. I didn't even realize that, of my newsletter, okay? But here's what you're going to do. Go to stockmarketcycles.com/register. This is what I recommend, the video commentary. If you want the application, you're going to love it, but you need to see it probably if you haven't seen it before. I might have time to show you a little bit of it at the end of this update. But here's what you want to do is go to Start Trial Now. This is the video commentary. Generally a very reasonable $59 a month. It's every market day. You click on Start Trial Now, and when you fill this out and get down to the coupon code, here's what I want you to write in there. 14 days free. I have it all caps here. I don't think it makes that big a difference. I'll ask my assistant, but I don't think so. But 14 days free, no spaces, all capital letters, 14DAYSFREE. And that's all you need to do. Okay? And you will get the next 2 weeks, which from what I'm going to show you, could be 2 of the most important weeks that the market has seen in a long, long time. So get your free trial started now before you do anything else, and let's get on with the show. Okay, I'm going to show you the most remarkable market cycle, turning point pattern, however you want to classify it, that I believe I have seen in my career of 50 plus years. And believe me, I've seen virtually all the cycles of my own, cycles of other people. They're important patterns a lot of times, and a lot of times they work for a while and then they don't work. And that may happen with this one. We don't know. But I want to show you how remarkable it is. Let me start out by showing you this monthly chart. Now you see the symbol up here. That's all a lot of gibberish. What this chart shows, what these data show, are a monthly chart of the S&P composite index. Before 1960-65, it was just called the S&P composite. But we have data going back to the beginning of the last century and even further back from the Foundation for the Study of Cycles. It wasn't called the S&P going way, way back, but this is the chart I want to show you, and please pay close attention. If you love markets like I do, this is one of the most fascinating things I have seen in a long, long time. Let me tell you how I came to this. If you look at this chart, you should be able to tell that you can see down the bottom of the screen where it says 10/31/74. That's October of 74. Remember, this is a monthly chart. I'm going to show you a daily and really break it up into daily bars very, very soon. That's the amazing part. October of 74, and look at this incredible move. 74 going all the way up. There was a crash in here. That was a beauty, down 35% or so in one day. But look at the complete trend here. When you look at it now, shoot, it doesn't look like it was anything at all. If this were a daily chart, you'd have one day down and then you'd continue the trend again. But where does it end? Well, it ends right up here. Let me show you a close-up. Right here, March of 2000. On the S&P, March 24th to be exact. And again, I'll show you the daily chart momentarily. I wanted you to get an overall view of what I was looking at here, and I got excited about. At the beginning of this year, I discovered that there was generally a pretty good quarter century pattern in the market, going all the way back to the beginning of the 20th century, the 1900s. There was an important market bottom just before 1900, let's say 1897, 98 or so. There was an important bottom preceding the move up into the 1929 high. I can show you that on this chart back here. That's right here, the 29 high, okay? And here's the 32 low. But the thing that attracted my attention after spotting this approximately 25-year pattern was this. October of 74, March of 2000. And then when I looked at this and I realized there had been approximate 25-year turning points in the market, I became fascinated because look what we've done. This is '09 back here. 16 years of virtually straight up market behavior. Right into last Friday, September 12th, new all-time high on the S&P. And that's shown right here, okay? Shown here in the monthly chart. Again, I'll show you the daily chart momentarily. But I looked at this and I said, you know, this is interesting because the period from October 4th of 74 to March 24th of 2000, I wanted to find out how many calendar days that was. And so let's go to a spreadsheet and I'll show you how I got involved. Okay, again, 14 days free. That's what you write. You get the next 2 weeks that could be, again, I don't want to be overly dramatic, but they could be among the most important market days we will see for a long, long time. But let's get back to the market. Put a date in, 10 October 4th, 1974. That was the exact daily low in the S&P. I'll show it to you on the daily chart in a minute. The top in 2000, March 24th, 2000. So now, being a cycle man, I want to know the time period between these two dates. Now, when you do cycles, you have the option. You can do trading day cycles or you can do calendar day cycles. Most of us people that are considered cycle experts use the calendar days because you don't do the distortions of holidays and rare occasions like, unfortunately, the presidential assassination of Kennedy. The market was closed for a day or two. Some special occasions where the market may close and not be in the regular flow of things, let's say, or there be a holiday that interrupts the market pattern. We use calendar days. So, how many days between October 4th of 74, an incredibly important low, and March 24th of 2000, a high from which the NASDAQ composite declined, I think, 78% in the next couple of years. That's how important this high was. So what's the number of days between them? Well, you simply do this. You take the 2000 and go down here and say equals this 2000 date minus the 1974 date and click return. And there you go. 9,303 days. Remember this, write it down. We might come back to it, we might not, but it could be important. So, I was aware of this time span And I wanted to project it into the future and say, hey, 9,303 days, let's take it out into the future. Maybe we'll see a turn as important as these two were, which historically two of the most important market turns in history, certainly over the last 50, 60 years. So now what we do is equals March 24th of 2000 plus this period of days that we calculated, 9303. And that's what we come up with. When was this date, folks? Yeah, this was Friday. As I talked to you 2 days ago, I'm talking to you on Sunday. This was Friday's date. So wait a minute now. Are you trying to tell us, Eliades, that this date, Friday's date, is going to be as important a turning point as these two dates were? October 4th of 74 and March 24th of 2000? That's a pretty bold statement, isn't it? Well, let's go back and look at the daily chart now. Okay, I was showing you the monthly chart. This is the daily closing price chart, S&P 500. And I've drawn my own little rising wedge formation. Typically, rising wedge is a bearish formation, but not until you break down out of it, okay? And look at this. There's 1, 2, 3, 4, almost 5 hits. Broke a little bit beneath it here, maybe a pre-omen of what's to come, and another hit here. And on the top, 1, 2, 3 hits. This is Friday, new all-time high right here. 65.84.29, the close on the S&P on 9/12/25. Okay, let's go back slowly. Well, let me bring these closer together so it doesn't take us too long. So this will put, you've got almost 4 or 5 years on the chart now, but let's start going back on this. See what a fabulous, incredible, almost unbelievable rally this has been. Here's the big 20 decline. This was like the sharpest decline from an all-time high in history in the smallest period of time. 25-30% decline in about a month. But then, boom, like it never happened. Let's continue back. This is fascinating. Okay, we're into 2012 in the middle. Here's the big 2007 to 2009 decline. It was a big one, 50+% in the S&P. But it was just a blip on the monthly chart on the way up. And here we are. Here you go, folks. March 24th, 2000. This is the high close in the S&P after an incredibly long bull market. And this high held for a long, long time, especially as we said, not so much on the S&P, although it held a long time here, but on the NASDAQ composite, it held for, 5, 6, 7, 8 years or longer. What we're interested in now, though, is this date of March 24th of 2000. And let me bring these closer yet. Okay, so there's March 24th, 2000. Now we've got, over 10 years of daily market activity as we go back. And just look at this. Up and up and up. Here's the crash right here. Okay, boom, it's like it never happened. The largest decline in history, again, in whatever amount of days it was. This was like October 19th on a Monday. I think that day alone was down about 20-25%. So it was an incredible move to the downside, but then recovered, new all-time highs, up, up and away. Going back, 1984 in the middle. Important bottom in August of 1982 right here. Okay? And what's coming up? October 4th of 1974. This was one of those almost an inverted V. Wow, did we come down hard, and wow, did we go up hard out of that bottom. So, these were the two measuring points that led to this past Friday, 9,303 calendar days. From 74 to this is 10/4/74. Let me quickly go forward. This low forward to this high, 9,303 days. Let's measure forward another 9,303 days, and that takes you to Friday of last week. So I got to explain this to you now. I proposed this to a really good market friend of mine, a very, very bright market friend of mine. He said, I mean, that's interesting that there's an equal time span there. But does that mean anything? I mean, there's no cycle there. There's no repetition before that. You've just got an exactly equal daily calendar time span, and you're moving it forward that same time span. And yeah, we're at new all-time highs as it's happening, so that may be suggestive that something's going to happen here. And yeah, we are at the most overvalued levels in market history. Let me quickly show you that, because that's very impressive. I was the keynote speaker for the Foundation of the Study of Cycles in June in New York City. And these are three of the charts I showed. I'll show them to you quickly here. The Buffett indicator, that's the ratio of total market capitalization divided by gross domestic product. And this is through, I don't know, several months ago. Okay. Only two readings in history above 200 plus. And now I believe we're at 212. So we are now at the highest levels in history. Now, this doesn't go back to the 1900, but it goes back to about 1970 or so. So over the last 50 years, on the Buffett indicator, most overvalued in history. This is from my friend Bob Prechter. This is a great chart. What it shows here is the dividend yield on the S&P 500, and it goes from a high to a low. In other words, it's a reverse scaling here. What is the dividend yield on the S&P 500? The smaller it gets, going to the right, the more overvalued the market becomes. The vertical scale is the S&P Industrials price to book value ratio. What's the current stock price of the index? And what's the book value of the index? So the further up you go on the scale and the further to the right you go on the scale, the more overvalued you are. Here we are, 2024. I think I figured recently where we were, it's above this number. It's off the chart. So look at all the dates in here. This is where we are in terms of valuation. Now, before I show you the next chart, it's going to look like this. Let me emphasize, valuation is not market timing. You can't look at the market and say, oh gosh, it's so overvalued here. Look at these numbers, look at these charts. Because markets can get more and more overvalued when they go to extremes. Let me show you the third one here, and this will be the last one. This is John Hussman's valuation. And it's all explained here. You can pause your video and look at it. I'm not going to go through it. I'm just going to show you that this is where we were several months ago, okay? This is valuation going into November of 24, so almost a year ago. We're higher than that now. Here's 1929. It's a little bit off the chart here, but this is where we were. So on all three of these charts, the market is at its most overvalued levels in history. Again, that alone doesn't promise you a market top. You are overvalued down here, and you are overvalued on the way up. All this area in here, you are overvalued. And you just kept getting more and more overvalued, okay? So overvaluation itself does not promise you a market top. But when you look at the preponderance of the evidence, as my old friend Stan Weinstein used to say, You can see this is the most overvalued market in history. Now what we have to do is figure out technicals and cycles to fit in to tell us where we might be experiencing that very important overvalued market top. Back to the chart. So here's what we know. My friend said to me, you only got, there's not even an iteration of a cycle. It's not like you said, 10 to 20 to 30. If you had that, you'd have at least two cycles, 10 to 20 and 20 to 30. We didn't have that when I showed this initially. All we had was 1974 to 2000. And that period came out to around 25 and a half years. And if you add 25 and a half years, that's what brings us into this current time zone and why I got excited. But I started thinking about what my friend said, and I said, wait a minute. As I looked at this, I said, I made a big case at the beginning of this year that there was a 25-year approximate quarter century pattern in the markets, because I knew there were important bottoms like around 1949, and you add 25 years to that, you come up to 74, important bottom, add 25 plus years to that, you come up to the 2000 top. Those were all very, very important time zones. So I said, okay, here's what I'm going to do. And I was almost afraid to do it because I was afraid it wasn't going to show anything. It was going to be inconclusive. Let's go back to the spreadsheet. Okay, here's what we got. We found the distance in calendar days from 10/4/74 to March 24th of 2000, 9,303. We add 9,303 days to March 24th of 2000, we come up with this date. Bingo. It was Friday, 2 days ago, 9/12/25. So now I say to myself, all right, be brave and go back 9,303 days and see if you have any consistency there. See if that pattern persists. So how do we do that? Mathematically, it's pretty easy. Instead of adding the difference between these and coming up with this date, we just take a new space here and say equals this date of October 4th, 1974 minus the period we came up with, 9,303 days. We'll even click on that just instead of writing it down. So now we're taking the date of October 4th of 74, we're putting it here and subtracting 9,303 calendar days. And what do you come up with? There it is. April 15th, 1949. So with a little trepidation, I went back to the chart and I said, let me find April 15th of 1949. I know there was an important low sometime in 1949, but I didn't recall the exact date of it. Let's do some exploring on that daily chart. Okay, I've got these bunched up as close as they'll go. Here's the latest time zone right in here. There's the 2000 high right there, March 24th. You can see the bottom of the screen. There's the 1974 low. You can see how very important these turns were. I mean, you now have 67 to beyond 80. You've got 13 years of daily prices on these charts. This 10/4/74 is the absolute lowest price on the chart. And you never came back to this again in the future. This 10/4/74 date was one of the most important bottoms in history. Okay. Now comes the fun. Do you all remember what date we're looking for? April 15th, 1949. Let's do our scroll. We're back to 53. Oh, there it is. I've got the vertical line. Look at this. That's unbelievable. Look at this. This is 9,303 calendar days before October 4th of 74. And look at this. Now, is it perfect? No, I've got to confess to you. Let me zoom in on it. It just looks perfect on the chart. But look at this. It was 2 days away. Oh boy, naughty, naughty, naughty. Look at this. Is this one of the most amazing things you've ever seen in the stock market? June 15th, 1949. Very important market low. Let me do this for you. We never ever got back to this price again. This is on the S&P now, remember, not the Dow. But it was around the 13 level. You can see over on the right there in the dark black. The closing low on June 15th was 13.90 on the S&P. Now let me do this. Let me draw a horizontal line at that low. Notice also that this low, going back to the left, I mean, it was the lowest price in 4 years, from 45 to 49. But going to the right, follow that horizontal line and watch it quickly disappear. It's still there. We're into 1962, but gone. It's gone. You never saw that price again in your lifetime. And there you go, folks. That, to me, was one of the most incredible cycle discoveries I have ever made. Chart of the S&P, and three of the most important turns, arguably, in over the last 100 years, fell exactly 9,303 calendar days apart. So now let's have just a little more fun. How about the one before this? Well, you might end up being a little disappointed. I was a little disappointed. Not much, but a little. I'll show it to you. Going back another 9,303 days, and let's verify it with the math, equals this minus 9303, October 26, 1923. Do we dare go back and look at that? Because I have that data. These data from the Foundation for the Study of Cycles go back, I mean, they really go back to 1789, even though that was not the S&P. I think it was called the Cowles Index or something like that. But let's, just for the fun of it, look at this stupendous record of 2000, 1974, 1949, some of the most important market turns in history. Let's look at it. October 26th of 23. I'll go back pretty fast, so I won't keep you in suspense. Actually, just remembered, I can't do it on this chart. Got to look at a Dow chart, because this chart only goes back to just before the 29 high. But let's look at a Dow chart. My head's in the way up here of showing the date. Actually, now that I've done this calculation with you in real time, I had it move forward a little bit. Look at this. This is the most remarkable thing I have ever seen. October 26th. Let's zoom in on this and see how far off this one was. Look at that. I mean, this was the low date, October 30th, but not by much. This is less than a few tenths of a percent. The close on the 26th, 86 even. 2 days later, 85.90. And look what happened after that. Never went any lower until the great crash. You're talking 9, 10 years later right here. But look what happened in the meantime. From this low, 10/26/23, this incredible, remarkable rally into the 1929 top. And there you have it. I mean, this is a long update now, I know that. But if you are a lover of markets, as am I, the markets are deeply embedded in my blood in my brain. I love the markets. And when I saw this, it was the most incredible thing I had ever seen. So, where does that lead us? Well, it leads us to this date. You can hardly see it that way. Let's do this. This date right here. Okay, now you say, oh, wait a minute, you were off by a day. We were actually down on Friday. Well, let me argue with that and show you this. Oh, I can't do it here on this chart. This is a close-only chart. But on the S&P bar chart, Friday was a higher high, a new all-time high in the S&P. And that's about it, folks. I have shown you what I consider to be one of the most remarkable market patterns I have ever seen. What causes that? Well, when I was on the old Wall Street Week show with the irreverent Louis Rukeyser, this is back in 1986, and he said to me, Peter, so you believe in these cycles, what do you think causes them? And I told him, I said, Lou, I really don't know. I don't think anyone knows. If I had to make a wild guess, I'd say I think it has something to do with astronomical configurations, and I was careful to delineate between astronomical and astrological. After all, we live in a world that revolves around the sun and a moon that revolves around us and the movements within the universe. There's a time clock to all these movements. People can predict them years and years ahead. They can predict solar eclipses from now unto eternity almost. Lunar eclipses, the same thing. How does that affect human behavior? Cycles? I don't know. That's a wild guess. But there may be some semblance of reality there. What I'm telling you is that this is one of the most remarkable patterns I've ever seen, and it's telling us right here that we have now completed another 9,303 days. And the pattern goes over 100 years now, okay? Back to 1923. And this is where it's due to resolve. Now, I wish I could tell you it's been wrong by 3, 4, 5 weeks in the past. It hasn't. It hasn't been. It could be this time. And this time, let's be honest, this time it could mean nada, nothing at all. The pattern fails. Cyclic patterns almost always fail at some time. And I'm sure sometime over the next millennium, this one will too. Will it be this time? We don't know. I'm just telling you that if you're invested, if you have anything to do with the stock market, you should be paying attention to what's going on right here and right now because of the pattern that I just took this time to show you. I hope you've been I hope you've remained with me throughout because I found this fascinating. Going back and proving the pattern to you with real-time market charts that go back historically for over 100 years. So now the market plays out its course. I want you to be, let me show you one more thing before I sign off. This is the kind of information you get on my daily market updates. This is software that was written for me by Stefan Schuerman, a young man originally from Germany that now lives in Dubai, that works on my website for me. These are market projections. This has been a long update. I'm not going to go through them now. I just want you to see that this is a closing price projection. And it gave this projection about a week ago, right in here, when this blue line, which is the closing price of the S&P, moved above these two offset lines. From this area right here, it gave a projection up here. And then you click there, and it gives you the numbers. So this is the only short-term projection that was outstanding. The low end is 65.6491. The upper end, 65.8818. The close on Thursday, 65.8746. Less than a point away from an exact hit of the upper level of this projection window. This is the kind of information you get every day on my videos, the ones that you can sign up for completely free for 14 days now, which may be 14 of the most important market days that you'll see in your lifetime. Maybe. No promises. I showed you the charts. I think if you have eyes and a brain to accompany them, you can see the potential importance of Friday's close in the stock market and what it might mean. And with that, I'm going to bid you a fair adieu. I hope to be talking to you soon. Thanks for watching.